I've been staring at the terminal for, it must be 4 hours now, just watching the 10-year yield. And it's doing something that, frankly, shouldn't be mathematically possible. Not if we still believe in basic supply and demand. See, the headline everyone is running with this morning, and you've probably seen it flashing on Bloomberg or CNBC, is that China is exiting. They're calling it a strategic pivot or a rebalancing, or whatever polite euphemism the PR departments are using today. But let's call it what it is. They are dumping. We're talking about a directive to commercial banks to limit exposure, effectively forcing a liquidation. The numbers we're seeing? China's holdings are down to somewhere around $682 billion. That is a 17-year low. They have offloaded $500 billion of US debt in a decade, and the pace just accelerated in the last 12 hours. Now, normally, in a market that actually functions, when your second largest creditor decides to stop rolling over debt and start selling it, the price of that debt collapses, which means yields, the interest rate the US government has to attract new money, should be spiking. We should be seeing the 10-year yield ripping past 4.5%, maybe 4.6% given the volume of this news. But look at the screen, 4.18%. Yields didn't spike, they crashed. They dropped below 4.2%. I want you to really sit with that for a second because it's disturbing. It implies that for every dollar of debt China is frantically trying to sell, someone else is standing there with a bucket, buying it instantly, aggressively, enough to not just absorb the selling, but to push prices up. Who has that kind of liquidity? Who steps in front of a freight train like the PBOC or China's commercial banking sector and says, "I'll take it all"? It's not the Fed. Not officially. Their balance sheet runoff is still technically on autopilot. So we have a mystery buyer, a ghost in the machine. And this ghost is distorting everything. It's creating a false signal of safety in the bond market precisely when the geopolitical plumbing is being ripped out. And this is where it gets dangerous for you, because if you're looking at silver sitting there at $81, maybe $82, and you're feeling comfortable because it's corrected from those January highs of 121, you might be reading this completely wrong. People are asking if silver is going back to $50, and they ask it like it's a buying opportunity, like it's a dip. But if this mechanism in the bond market, this artificial bid that's hiding the China exit, if that snaps, $50 isn't a support level. It's a floor that might not hold if the liquidity vanishes. Something is effectively broken in the way risk is being priced today. February 10th, 2026 might be the day the bond market finally stopped telling the truth. And if the bond market is lying, gold and silver are the only things that are going to tell you what's actually happening. I want to walk through the plumbing of this, not the headlines, the plumbing, because what's happening in the repo market right now to hide this exit, that is where the actual risk is sitting. So let's peel back the repo market, because that's where the noise stops and the mechanics actually begin. And if you're trying to figure out if your portfolio is insulated or if you're just sitting on a powder keg, you have to look at who is on the other side of this trade. We established the anomaly. China is selling. Yields are falling. That's the contradiction. Now, usually when you see a divergence like that, a massive seller meeting a massive buyer without price destruction, it means one of two things. Either the central bank is intervening off the books, which, look, people love to speculate about that, but it's rarely that clean. Or, and this is the far more terrifying option, the domestic market is scared enough to front-run the government. And that's what I'm seeing here. The mystery buyer isn't some dark pool operator or a rogue sovereign wealth fund. It's fear, domestic institutional fear. Think about the last 3 labor reports. Not the headlines, but the revisions. We've seen downward revisions in payrolls for 4 consecutive months leading up to January 2026. The real economy, the one that drives tax receipts and consumption, is cooling rapidly. And smart money knows this. They smell a recession. And when you smell a recession in the United States, what is the muscle memory trade? What have 40 years of financial conditioning taught every fund manager from Boston to San Francisco to do? You buy treasuries, you buy the long end, you lock in 4.2 or 4.3% because you're betting that in 6 months the Fed is going to be cutting rates to 3% or lower to stop the bleeding. So here is the setup, and it's ironic, really. China is exiting US debt because they don't trust the long-term value of the dollar, and they want to reduce their vulnerability to sanctions. They are selling for geopolitical reasons. They are looking at the weaponization of the financial system and saying, we're out. But US institutions, the pension funds, the insurers, the banks, they are buying, are terrified of a cyclical crash. They are buying for survival. And right now, on February 10th, the fear of a US recession is actually stronger than the fear of a Chinese exit. That is the only mathematical way you get yields dropping to 4.18% while your second largest creditor dumps billions. The domestic panic is absorbing the foreign liquidation. This next part is where it stops making sense, though, or at least where it stops being comfortable. If domestic capital is soaking up all this supply, what happens when the recession actually hits? Because right now they are buying the expectation of a slowdown. They are pricing in a soft landing or a mild recession where the Fed cuts rates and bonds rally. It's a clean narrative. But if China keeps selling, and we know they have another 600 billion or so to go, and then the US economy actually tips over into something harder, suddenly that safety trade becomes a trap. You're holding an asset, US Treasuries, that is being structurally dumped by the East while betting that the West will keep buying it forever because they're scared. That works for a month, maybe a quarter, but it's not a strategy. It's a crowded theater with everyone running for the same exit, and the exit is labeled Treasuries. And this brings us to the hard numbers, because you need to understand the scale of what is moving underneath us. We know China's holdings are at that 17-year low, $682 billion, give or take. But look at the velocity. The pace of selling has accelerated. This isn't a drift anymore, it's a march. Now look at silver. Silver hit $121 an ounce in January. That was the blowout top. Everyone got excited. The squeeze is here, right? And then it retraced violently, down 30% in weeks. We're sitting here in the low 80s, $81, $82. And here is the disconnect that keeps me up at night. If the bond market is right, if we're heading for a deflationary bust, a hard recession where demand collapses, then commodities should be getting crushed. Copper, oil, silver, they should all be tanking. And they have softened, sure, but silver at $80, that is historically incredibly high. So we have a bond market pricing in a depression and a precious metals market pricing in, well, something else. Maybe a currency crisis, maybe a total loss of faith in the sovereign ledger. This is where most people get trapped. They look at silver and say, it's correcting, I'll wait for $50. But if China is selling treasuries to buy gold, and by proxy, silver moves with gold, then there is a physical floor under this market that didn't exist in 2008 or 2020. In 2008, when the credit crunch hit, gold and silver collapsed initially because everyone had to sell everything to raise cash. Liquidity dried up. But this time, the liquidity is being provided by the very thing they are selling, the treasury market. China sells bonds, liquidity event. China buys gold, hard asset event. The US bond market absorbs the bond sales, domestic fear, so the liquidity isn't drying up yet. It's just changing hands. And that's why the silver to $50 narrative is so dangerous. If you're waiting for $50 because you think it's a standard cyclical correction, you're betting that the mechanism remains intact. You're betting that the mystery buyer, the US domestic bid, keeps showing up every morning to buy what China is selling. But what if they stop? What if the inflation data ticks up next week? Just a little bit. Just enough to spook the Fed out of cutting rates. Suddenly, those US pension funds stop buying bonds because yields might go higher. The safety bid evaporates. And now you have China selling with no buyer. That is the moment the floor falls out. Not for silver, for the bond market. Yield would spike from 4.18% to 5.5% in days. The dollar would scream higher initially as a wrecking ball, crushing equities, crushing crypto, and yes, probably smashing silver down to that $50 level in a panic liquidation. That is the crash scenario. It's not about silver's fundamentals. It's about a liquidity vacuum in the Treasury market that forces a global margin call. So when I see headlines today saying market shrugs off China move, I don't see resilience. I see complacency. I see a market that has convinced itself that the Federal Reserve will always be the buyer of last resort. But remember, and this is critical, the Fed is currently trying to reduce its balance sheet. They are not buying. They are letting bonds roll off. So we have the Fed stepping back, we have China stepping out, and we have the US private sector stepping in, leveraged to the hilt, betting on a recession. It is the single most crowded consensus trade I have seen in my career. Long bonds, short economy. And whenever the entire market is on one side of the boat, usually the boat tips over. I want to pivot to something specific here, the actual plumbing of the China exit, because it's not just about selling bonds, it's about how they are doing it. They aren't just dumping on the open market. If they did that, we'd see chaos. They are likely using Belgian accounts. They're using swaps. They're letting maturities roll off without reinvesting. It's a silent exit. But the net effect is a withdrawal of collateral. US Treasuries are the collateral of the global financial system. They are the pristine asset you pledge to get a loan, to open a trade, to leverage a position. When the supply of that collateral effectively changes hands from a stable holder, China holding for decades, to a flighty holder, a US hedge fund front-running a rate cut, the quality of the market degrades. It becomes more volatile, more prone to sudden air pockets. And silver is the canary in this coal mine. If you see silver suddenly plunge, I mean a $10 or $15 drop in a single session, it won't be because industrial demand for solar panels disappeared overnight. It will be because something broke in the repo market. It will be because the collateral chain snapped and someone, somewhere, had to sell their gold and silver to cover a margin call on a bond position that went wrong. That is the risk. The $50 silver price isn't a target based on value, it's a target based on liquidation. But, and this is the but that no one is talking about, if the US domestic buyer doesn't blink, if the recession is real and capital keeps flooding into bonds driving yields down to 3.5% or 3%, then the dollar weakens, the yield advantage evaporates. And in that scenario, China's selling looks like genius. They got out at the top and they moved into gold and silver while the dollar was still strong. So you have to ask yourself, do you trust the US labor market data? If you think the labor market is strong, then this bond rally is fake. It's a bubble, and when it pops, yields spike and everything crashes. If you think the labor market is dead, then this bond rally is real. Yields go to 3%, the dollar dies, and silver at $80 goes to $150. Those are the stakes. It's binary. There is no middle ground where everyone is happy and we just muddles through with 2% growth and 2% inflation. That world is gone. We are oscillating between deflationary bust and currency crisis. And the China exit just removed the shock absorber. In a minute, you'll see why that number, $682 billion, doesn't mean what people think. It sounds like a lot of ammunition left, right? Like they have plenty more to sell? Actually, it's effectively zero. I'll explain why, because once you strip out the custodial holdings, the agency debt, and the amounts needed for trade settlement, China might effectively be out of tradable treasuries already, which means the selling pressure might stop, but so does the leverage. Let's look at the mechanism, because if China is actually done selling, if this was the final flush, then the bond market is about to lose its biggest excuse for volatility, and we're going to find out what the real price of money is. So why is $600 billion effectively zero? It sounds ridiculous, right? It's more money than the GDP of most countries. But in the world of sovereign finance, reserves aren't just a savings account you can empty out at an ATM. They're operational collateral. Think of it like the oil in your car engine. You might have 5 quarts in there, but you can't use all 5 quarts to drive. You need a minimum level just to keep the pistons from seizing. If you drain it below that level, let's say below 3 quarts, the engine destroys itself. For China, that minimum oil level is probably around 5 or 600 billion. They need that specific amount of US Treasuries just to settle trade, to manage the yuan's peg, to participate in the international SWIFT system, and to collateralize loans for the Belt and Road Initiative. They can't sell it. It's frozen. It's structural. So when we see them down to $682 billion and we see them issuing guidance to banks to limit exposure, that tells me they are scraping the bottom of the tank. They are selling the excess. They are liquidating the investable portion. This is the mechanism most people are missing. The market thinks this selling can go on forever. China will sell until they reach zero. No, they won't. They can't. They are likely hitting the functional floor right now. And if they stop selling because they have run out of sellable inventory, suddenly that massive supply of bonds hitting the market every day disappears. And remember the mystery buyer, the terrified US pension funds and banks who are front-running the recession? They are still buying. They are still panicked. So you take away the biggest seller, China, but you keep the desperate buyer, US domestic. What happens to price? It rips higher. What happens to yields? They collapse. This explains the 4.18% anomaly. The market is sniffing out that the selling pressure is exhausted. And if yields crash, I mean really crash, down to 3.5% or 3%, the dollar index falls off a cliff. And that is the rocket fuel for gold and silver. It's not about inflation this time. It's about the scarcity of collateral. But there is a trap here, and I see it in the institutional flows every day. The flight to safety trade, buying bonds, is crowded. It is the most consensus trade on Wall Street. Every hedge fund is long bonds, short the economy. And whenever everyone is on one side of the boat, the universe has a funny way of tipping it over. This is where I have to stop and be honest about what could blow this whole thesis up, because I don't want to give you a doom loop narrative if the data doesn't support it. If I am wrong, and frankly, for the sake of my own portfolio, I hope I am, it will be because the US economy is stronger than the bond market thinks. If next month's labor data comes in hot, if we see non-farm payrolls jump back up to 200,000, if GDP prints at 3% instead of 1% everyone expects, then the recession trade is wrong. The mystery buyer will disappear, the US institutions will panic out of bonds. In that scenario, yields don't fall. They explode back to 5%. The dollar rips higher, and silver at $80 would look incredibly expensive. In a high-growth, high-yield environment, silver could absolutely crash back to $50 or lower. That is the Goldilocks scenario. The US economy accelerates, China's exit is absorbed by growth, and the crisis is canceled. I watch that possibility every morning. I look for it, but I don't see it in the data yet. What I see is a banking system that is quietly tightening. I see commercial real estate loans going bad in Chicago and New York, hidden by extend and pretend accounting. And I see a consumer who is tapped out. So we are left with two paths, and this is the binary setup I mentioned. Path 1, the soft landing narrative, holds. The Fed cuts rates gently. China stops selling because they hit their floor. The dollar stabilizes. Silver drifts lower, maybe retesting $60 or $70, but stays in a bull market. This is the boring, manageable outcome. Path 2, the liquidity air pocket. This is the one the bond market is whispering about. In this scenario, China stops selling because they have to, but the US economy doesn't recover. It gets worse. The mystery buyer panics and doubles down, buying more bonds. Yields crash to 3%, the dollar index breaks below 95. And suddenly, capital has nowhere to go. It can't go into stocks because earnings are crashing. It can't go into bonds because yields are zero. Where does it go? It goes to the only asset that has no counterparty risk. It goes to the asset that China just finished buying with all the money they pulled out of treasuries. It goes to gold and it goes to silver. That is a silver squeeze mechanism. It's not Reddit traders buying coins. It's global capital fleeing a broken bond market where the yields no longer compensate for the risk. So how do we know which path we are on? We don't have to guess. There's a specific signal flashing in the repo market right now. the SOFR rate that tells you exactly how much stress is in the system. And what it's doing this week, it's doing the exact opposite of what the textbooks say it should do. So the SOFR rate, the secured overnight financing rate, it's the heartbeat of the repo market. It tells you the actual cost of cash overnight secured by treasuries. And usually it hugs the Fed rate like a shadow. It's boring. It's supposed to be boring. But look at yesterday's close. It didn't hug the Fed rate. It traded through it. It traded below the floor. That shouldn't happen. It means there is so much cash flooding into the short end of the market, so much desperation to park money in something safe overnight that lenders are practically paying borrowers to take it. It's a collateral shortage. This confirms everything we've been talking about. The system isn't breaking because there's no money. It's breaking because there's too much money chasing too few safe assets. China is taking the collateral, the treasuries, and the US banking system is drowning in the cash that needs to be collateralized. And that is a singularity moment for silver. If this collateral shortage gets worse, the Federal Reserve has a playbook for this. They have to inject more reserves. They have to restart QE or something that looks just like it to soak up that demand. If they do that, if the Fed expands the balance sheet to fix the plumbing, then the dollar devalues instantly. And silver doesn't go to $50, it goes to $100. It goes to $150 because the denominator, the dollar, is being diluted to save the bond market. But if they don't intervene, if they let the recession play out and yields crash naturally, then we get the deflationary bust. We get the hard landing. In that world, everything sells off at first. Stocks, crypto, real estate, and yes, silver probably takes a hit down to that $50 level we talked about. But here is the difference. In a depression, silver at $50 is the buying opportunity of a lifetime because the government will respond. They always do. They will print, they will stimulate, and the rebound from that $50 floor will be violent. So here is my playbook. What am I actually doing with my own capital while China exits and the US panics? I'm not chasing the momentum. I'm not buying silver at $82 thinking I'm going to get rich next Tuesday. That is a gambler's trade. I am holding. I am holding the physical metal because I don't trust the counterparty risk in the paper market. If the repo market seizes up, I don't want to claim on silver, I want the silver. And I am watching one specific number, the US 10-year yield. If it breaks below 4%, if we see a 3 handle on the 10-year yield, then the game has changed. The recession is here. The mystery buyer was right, and the China exit was the smartest trade of the decade. But if yields snap back up to 4.5%, then the bond market is wrong. The mystery buyer is trapped, and we are about to see a liquidation event that will make 2022 look like a warm-up. I'm not betting on the outcome. I'm positioned for the volatility. Which brings me to the question I want you to answer for yourself tonight. Not in the comments, I don't care about the engagement algorithm, but in your own notes. Do you trust the bond market's signal of a crash, or do you trust the stock market's signal that everything is fine? Because they cannot both be right. One of them is lying, and usually the one with the most leverage is the one telling the truth. Next time, I want to show you a document that just came out of the BIS, the Bank for International Settlements. It's dense, it's boring, and almost nobody read it. But on page 14, they outline a new framework for capital flow management during sovereign debt crises. Basically, they are talking about capital controls. If you are holding assets that you think are yours, you need to see what they are planning to do to keep them in the system. I'm going to break that down next. Stay safe out there. You know, I've been